Greetings class and welcome back. This is Accounting 201. In this video I'm going to go through a few demonstration problems and they're in this document that I've included in the Chapter 5 module. Now the first problem says Wahlberg Associates antique dealers purchased goods for $75,000. Terms of the purchase were FOB shipping point, and the cost of transporting the goods to Wahlberg was $2,400. Wahlberg Associates insured the shipment at a cost of $300, and prior to putting the goods up for sale, they cleaned and refurbished them at a cost of $980. Determine the cost of inventory. So we want to do that right here. We're going to say, okay, cost of inventory. We're going to include a few things. We're going to start with, obviously, the cost of the goods. So we purchased them for $75,000, okay? All right, and then we add in the cost. When we say FOB shipping point, that means the purchaser pays. When we say FOB, it's free on board. It's free on board at the shipping point, which means that as the purchaser, we're paying for those. So shipping costs are something Wahlberg pays. That's $2,400. Okay. They also paid for insurance to cover the goods while they were in transit. The insurance was $300. And then finally, they have cost of preparing them for sale of $980. So the cost of cleaning and refurbishing, etc., is $980. We wind up then with a total cost for these goods of $78,680. This is an illustration of the cost of acquiring something and getting it to your place of business and getting it set up so that you can actually sell it or use it in your business, placing it into service. All right, so for the next item we have down here, problem number 2, it says Laker Company reported the following January purchases and sales data for its only product, and they have a list here of purchases and sales. The requirement is that they're using a periodic inventory system, and they want us to determine the cost associated with ending inventory and cost of goods sold using specific identification, weighted average, FIFO, and LIFO. So first, with specific ID, or specific identification, what that means is we're going to look at ending inventory and cost of goods sold to see what specific items are included. And basically here it tells us ending inventory consists of 200 units, where 180 are from the January 30 purchase. So we're kind of working backwards here, but we go down to 130, and we have 180 in ending inventory, and the cost is $450. So that equals a cost at ending inventory of $810 for that particular item. And then we have 5 from this January 20th purchase. So we have January 20th, we have 5 units at $5. That equals $25. So we have $25 in ending inventory there. And then we have 15 from beginning inventory. So this is like January 1, beginning inventory. We have 15 at $6, which equals $90. Okay, so our cost of ending inventory using specific identification is $925. All right, the cost of goods sold is going to be the complement of that. That is, it's going to be everything except that was in the inventory except for what was in ending inventory. In other words, it's all this stuff that we purchased except what's here. So for cost of goods sold, we're going to have, we had 15 items left in ending inventory for the January 1st purchase. Well, we had a total in January 1 of 140 units. That means 125 are in cost of goods sold. Okay, 125 plus 15 is 140. So 125 at $6. That's going to be $750. Then for January 20, we had 60 units total, but we had 5 units left. That means that we, in cost of goods sold, we had 55 units at $5. That equals $275. Okay, and then January 30th, we had a total of 180 units. We had all of them left in ending inventory, so that means we had 0 in cost of goods sold at $450. So that's $0 here. That means the cost of goods sold, when we add these up, is $1,025. So, as you can see, if you add these two together, you come back to the units acquired at cost. But this is the specific identification. In this format, they're going to tell you how much is left in each specific layer of inventory. It's not going to work that way with FIFO and LIFO. So let's move on to the next category, which is going to be weighted average. Weighted average just is lumping it all together. So for weighted average, it's a much simpler approach. What we do is we say, okay, we determine the cost of goods available for sale. Cost of goods available. Actually, it should be just cost of COG, but anyways, cost of goods available. And if we look at this in total, it's this 1,950 right here. 1,950. We divide that by the number of units. So we have number of units, and the number of units is 380, which is right here. So we divide that out and we get $5.13. This is what we have on an average. So we say cost of goods sold. And when we say the goods sold, we have 180 units right here. So we take 180 times $5.13, and we get $923.40. That's cost of goods sold. We have ending inventory, and the units in ending inventory, when we add all these up here, it's 200 units. Because we had 380 to start with, 180 in cost of goods sold. 200 units at 513 is going to give us $1,026. That's a period or a decimal. So anyway, that's the way we calculate this. Now, when we're looking at weighted average, we're basically splitting the difference between the FIFO and LIFO methods, okay? So if we look at the weighted average, it comes in between FIFO and LIFO, and I want to show you what I mean by that here in just a second. Let me get this arranged. Alright, so now we want to do a FIFO and LIFO method. So we start with FIFO. What that means is first in, first out. Now, most of the time, this reflects the actual flow of goods in a business, because most of the time, when you're purchasing items, you're putting the oldest items out first so you can sell those and rotate stock. So using a FIFO method, we're going to say the first units we purchased are the first units sold. So what we want to begin with here is saying, okay, we know how many units we sold. So we have cost of goods sold here. And the total units we sold were 180. That means ending inventory has 200 units left. Of these 180 units, we're going to assume that we sold all of beginning inventory because we had 140 units in beginning inventory. And those 140 units were costed out at $6. That'll give us an $840 cost in beginning inventory. And then we're going to have the purchase at January 20th, which is right here. And we had 60 units in it at $5. Now, the only thing we need to make up the total in cost of goods sold is 40 units, which means we're going to assume that the 40 units came out of this January 20th layer, and that we have 20 units left of that. So 40 units at $5 is equal to $200. That means that our cost of goods sold under FIFO is going to be $1,040. Okay? Ending inventory, this is going to be the complement of what we have here. So we don't really have anything left in beginning inventory. Alright? The unit cost there was $6, but we don't have anything left because we don't have any items left. Here, for FIFO, we have 40 units in cost of goods sold, but we purchased 60. So we're going to have 20 left here. And that's going to be $5 per unit. $5, not 500. So that's going to be $100 here because we have 20 units at 5. Ending inventory on January 30th, we have a total of 180 units that we purchased on January 30th. All of those are going to be in ending inventory because we assume under FIFO we sold the others first. This is $450, and the total cost then would be $810. So we would have a total cost in ending inventory of $910. So what this illustrates is, with a FIFO method, first in, first out, first items purchased are considered the first items that go into cost of goods sold. So beginning inventory in January 20th, all of beginning inventory and most of January 20th will go into cost of goods sold. The balance, the items purchased last, will go into ending inventory. Using LIFO, we're going to use the opposite assumption. Now, FIFO reflects an actual flow of goods, because if you're in a typical business, most of the goods you have an expiration date. You're going to rotate them based on the date you purchased them so that you sell them before the expiration. LIFO is not necessarily reflective of how you actually sell goods, but it is an approach that is used in order to gain a tax advantage many times, because if you use FIFO, you have a higher ending inventory and a lower cost of goods sold, and you have higher net income. Using LIFO, I'll show you how this works. We'll do the illustration here, because the lower the cost of goods sold, the higher the net income. The higher the cost of goods sold, the lower the net income. So with LIFO, we're going to assume beginning inventory is left in ending inventory. We're going to assume the first items we purchased are not the first items we sold. So this $140 or 140 items at $6 will be still in beginning inventory. That's 840. Okay. And then the January 20th purchase, we're going to assume that will also be in ending inventory, because we're going backwards. We're saying, okay, we're going to take ending inventory first and then look at cost of goods sold. So here in ending inventory, we need 200 units. So we have 60 at $5. That'll give us $300. And an ending inventory of 1,140. Okay? The cost of goods sold here will be, we're not going to include any from these first two layers, but we're going to do it all from the January 30th, which will be 180 units at $4.50. And that will be a total cost of $810. Now normally, if you're using LIFO, especially if costs are going up, this will produce a lower net income. Here it works in reverse, because the costs are actually going down. So if costs are dropping, LIFO produces a lower cost of goods sold and a higher net income. If costs are increasing, LIFO will produce a higher cost of goods sold and a lower net income. All right. So that's the first example I wanted to go through with calculating cost of inventory and cost of goods sold. The next item we have here says Lopez reported the following current year data for its only product. The company uses periodic inventory, and its ending inventory consists of 150 units, 50 from each of the last three purchases. Determine the cost assigned to ending inventory and cost of goods sold using specific identification, weighted average, FIFO, and LIFO. So this is a lot like the last problem we had, all right? So we're going to start with specific identification. And with this, a specific ID, we're going to start by identifying which layers of inventory actually items were purchased out of or items were sold out of. So we're going to have the dates of the purchase. We'll have beginning inventory. We'll have March 7th. We'll have July 28th. We'll have October 3rd and December 19th. Part of this will be in cost of goods sold, and the other part will be in ending inventory. So basically they tell us that the company uses periodic, and its ending inventory consists of 150 units, 50 from each of the last 3 purchases. So here's what I'm going to do. I'm going to do the ending inventory first because they give it to us. We have 50 units from 12/19 at the cost here is $2.90, and that total will be 145. We have 50 from 10/3, and that cost will be $2.80, and that will be 140. Then we have 50 on July the 28th at $2.50, and that will be $125, okay? All right, so we have those 3 items. Our cost of ending inventory based on that is $410. Now everything else goes into cost of goods sold. So we originally purchased 160 on December 19th. That means 110 is in cost of goods sold at $290. That is $319. Okay. Then on October the 3rd, we have 480 units purchased, but 50 in ending inventory. That means 430 were sold at $280. So that means we have 1,204 in that cost of goods sold. July 28th, we had 544 units, and 50 of them were still in ending inventory. So the difference is we have 494 units from July 28th at $250. And the cost there will be $1,235. All right. And then all of the other costs are going to be included. So on March the 7th, all 220 units are here at $225 for $495. Beginning inventory then is 96 units at $2, and that equals $192. Our total then, when we're looking at cost of goods sold, is $3,445. When we add that to the 410, we come back to the cost, the total cost here of $3,855. All right? That's specific identification. The next item we want to do is weighted average, which is, like I said, very straightforward. So when we're doing weighted average, we're just taking this total cost divided by total units. So we take total cost of $38.55 divide by total units of 1,500, and we get an average then of $2.57 per unit. All right. Then we say, okay, how much do we have in ending inventory? Well, or in cost of goods sold. Well, in cost of goods sold, if we add all these up that we looked at here, we're going to have 1,350 units here. And if we add all these up, we have 150. So cost of goods sold is 1,350 times 2.57, and that gives us 3,469 If we take ending inventory, we have 150 units times 257, and that gives us $385.50. Okay, now that's the weighted average approach. Now when we get down to doing the FIFO and LIFO, the weighted average will come in between those. And so for FIFO, remember what we were doing. We were looking at the first items purchased were actually the first items sold. So when we do FIFO here with this particular approach, we're going to say the beginning inventory is all in cost of goods sold. So with FIFO, we're going to put everything in cost of goods sold first from the beginning down. So looking at this, we'd say all 96 units at $2 go in cost of goods sold. That's $192. Then we say the March 7th purchase, 220 units at $225, meaning $495 all goes into cost of goods sold, $495. Okay, then on July 28th, we had 544 units at $250. That gives us $1,360. All right. And then on October 3rd, we have all those purchases of 480 units at $2.80 or $1,344 going into cost of goods sold. Now the last layer of inventory, we have 160 units purchased, but we have 150 units left in ending inventory. So what we're going to have here is we'll have 150 units in ending inventory in this last layer at $290, and we'll have 10 units at $290 in cost of goods sold. So we'll have $29 here, and over here we'll have $435. So our total cost then, here if you add up all these units, you get $1,350, and the total cost will be $3,420. And over here you'll have 150 units at $435 in ending inventory. Okay? And if you look at that in comparison to the weighted average, this cost for the cost of goods sold is a little bit lower than the weighted average, and ending inventory is a little higher. It'll reverse itself with a LIFO approach. So let's take the LIFO approach next. Using the same data, so we use beginning inventory. We're going to split it between cost of goods sold and ending inventory. So with LIFO, we're going to assume everything in the opposite direction, right? So we have 96 units in beginning inventory. We're going to put all 96 units there in ending inventory because we're going to consider the first things we purchase to be the last things that we sell, and the last things we purchase to be the first things we sell. So 96 at $2 gives you $192. And then this purchase here, 220, we're going to split it between cost of goods sold and ending inventory. So on March the 7th, we have 54 of these units going into ending inventory because we need 150 in total. So 54 plus 96 is 150. 54 at 225 gives us a cost of 121.50. And then in cost of goods sold, we have 166 at 225. That gives us a cost then, and cost of goods sold of 373.50. Okay, now we've accounted for the entirety of ending inventory. So we have 150 units here and a cost here of $313.50. Everything else goes into cost of goods sold. So on July 28th, it's all of these units, 544 at 250. That gives you 1,360. On October 3rd, you have 480 at 280. That equals 1,344. And then finally on December 19th, you have 160 at 290, and that will be 464. So what you wind up with here, cost of goods sold, will be $3,541.50, and a total unit will be 1,350. Now the point here is this 3541.50 is higher with LIFO because you're in a period where costs are increasing, and this will make your net income lower. With FIFO, it's the opposite. If you're in a period where costs are rising, cost of goods sold are going to be a little bit lower than LIFO, and your net income will be bigger. The weighted average method just splits the difference between the two. It comes in right in between. See, 34.69 for cost of goods sold is right between 34.20 and 35.41. So that really is calculating ending inventory cost and cost of goods sold. If you have any questions, feel free to let me know.